Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place.
Welcome back for another episode of Opto Sessions. I'm Hayden Brain, and today I'm talking to Chris Kimble, founder of Kimble Charting Solutions, an all-round technical analysis expert. With an archive of charts committed to memory dating back to the 1700s, spotting repeating patterns and likely outcomes in current markets is where Chris has made his name. Did overconfidence in dumb money precede this market crash? Can we use crowd theory to understand pandemic-induced volatility? And which sectors most interest Chris if the market recovery holds? You'll hear all this and more on today's podcast. Hello and welcome, Chris.
Hello, Hayden. How are you?
Yeah, very well, thanks. How are you doing today?
Fantastic. And I'm very excited to be here. It's an honor.
Great stuff. So first of all, I just wanted to cover your background loosely for anyone that might not have heard of you. And my first question would be then, when and where did you first start trading?
Well, I graduated, as you said earlier, Hayden, in December of '79. And I was approached by a company to open up what they called a financial planning business at the time, Hayden. And I've got to say that term was rather unknown in 1980, but they said it could be a good futuristic business endeavor. So I gave it a try, and so I opened up my financial planning practice in February of 1980, and don't know a lot now, but I sure didn't know much then. But I gave it the old college try and opened the business, and here we are. It's hard to believe 40 years later.
Yeah, interesting. So I read that you, and I mentioned it in my intro as well, that you were trading mutual funds via Ridex investments in the 90s. Could I just sort of get a bit of clarification on the sorts of accounts you were trading? Were you trading your own money at that point as well as other people's and institutional money?
Great question, Hayden. And I'm going to back up just a second. That, as I shared, I started in 1980, and it's hard to believe today, but when I got into business, Hayden, the Dow Jones Industrial Average was at 1,000, and it had been at 1,000 15 years earlier. So it wasn't a very impressive endeavor or to go talk to somebody about stocks at that time, because they just hadn't done well for a decade and a half. And the thing that was doing well was gold at the time I got in the business. It was 800 an ounce. Interest rates were double digit. After opening my business, I got my first mortgage in 1983, Hayden, and it was 12.5% fixed at the time. And so I was fortunate. It always helps to get lucky that when I got into the business, that was about the time that the Dow decided and the major stock indices to break away from their sideways channel that had lasted 15 years. So I was fortunate that to preach the idea of buy and hold, which I didn't have anything with inventing, it worked extremely well early on in my business, and it continued to work well for years. And so when you mentioned the Ridex funds, how those came to be, it was actually in the late 90s. I was fortunate that my mentor was a gentleman by the name of Sir John Templeton, which founded the Templeton Funds. And I became a top producer with their organization because I really loved his consistency of performance. Even during the flat market from 65 to the early 80s, Hayden, he averaged 15% a year in his Templeton Growth Fund. So that really impressed me that he did so well in a flat market because it was a global fund. And where my life really changed was meeting him. But the biggest thing was in the late 90s, he said something to me that actually depressed me at the time. Hayden, he said, "Chris, I'm going to give you numerous reasons why I think the market will at best be flat for the next 15 years. So if you can imagine that you were preaching buy and hold on a regular basis that had worked, and then one of the world's most successful investors is saying, well, what you're suggesting will not do well for your customers, I had to then come up with some different type of ideas. Now, it didn't mean that Sir John was going to be right, but I sure had to put a lot of faith and trust. And I came back. We were in the Bahamas at the time. That's where his global offices were. And I came back to Kansas kind of depressed. And so that's where I started, Hayden, doing a lot of work on speeding up my knowledge of technical analysis and moving my customers' money over to the RIDEX funds. Because at the time, Hayden, there was no ETFs that had been invented yet, but RIDEX was the originating company of the long or short mutual fund complex, and that you could trade within their complex. They didn't raise an eyebrow on frequency, and they didn't charge you for going back and forth.
Right. Yeah, I see. So, I mean, it obviously works then. You were able to outperform during a serious bout of volatility around about 98, I believe. So could you then dig into what it was that you were doing differently to the rest of the market to achieve that outperformance?
Well, what I've done is, Hayden, I kind of, great question. I took off my buy and hold hat, and by the late 90s, I was able to convert my book of business over to RIDEX, but it really took 3 more years from the 2000 top to really show that it paid off. And so I didn't want to experiment with my customers' money, Hayden, on technical analysis. I still felt fairly fresh in it. But the one thing I felt like I could do was apply moving averages, that if Sir John was right, that if the market was going to struggle, I felt comfortable that, well, then the markets would probably be below moving averages. And if they were, I'd do a combination of cash and inverse funds. But what if Sir John was wrong? Well, if he was wrong and the market kept going higher, I'd just remain on the long side. So it took until 2003, as you mentioned, when the RIDEX started noticing, because the S&P had fallen 50%, they were keeping track of everybody's accounts, but they wondered why our accounts were at all-time highs. And so it was through the application of essentially the moving averages that helped me tremendously through that time period, that as many people held through the 50% decline, we not only didn't hold, we actually preserved capital and then scored on defense by owning their inverse mutual funds.
Sure. Okay. That's interesting then. I mean, you must have got to grips with the technical analysis pretty quickly then. I mean, they asked you to embark on a 60-city tour of the US teaching technical analysis. So I guess, was that the first time you taught technical analysis to other people?
It was, Hayden. I think they thought I was smarter than I was, but I thought it was a great opportunity. I didn't do anything highly sophisticated in the technical analysis world, Hayden. I just, as you know, the moving averages have been around for well over a century, and that's one thing I felt confident in, is that from a mathematics perspective, if I used a combination of moving averages, and that was kind of the little unique thing that I did. But if the market was below the average, we'd get out of the market, and then we'd short with some of it, and then we would ride it for as long as it panned out. And for moving averages, the period, Hayden, between 2000 and 2003 was very clean. It had some counter trend rallies, but for the most part, it didn't collapse the 50% at once, but it just continued to erode and erode and erode. And as you know, during that time frame, the NASDAQ fell 90% in value. So that was really a helpful short, during that time. And I was honored that they asked. It was a very taxing time period, because that much traveling in a 90-day window, I have to humbly admit there was a few times I forgot what city I was in, because they were happening so fast. And but it was a great endeavor to meet people and just try to show people how you could do something different from buy and hold and be productive with assets.
Yeah, that's interesting. And then, so I guess on the back of that success, then you sold your financial practice in the 2000s, I believe, to concentrate on this teaching side of things. Would it be fair to say that teaching is your passion?
Went away. That's kind of what we're doing today, as I love sharing. When I found myself kind of overwhelmed, Hayden, I was still trying to run my practice. I was selling signals to a company that managed pools of money and variable annuities in the tax sheltered annuity complex. I was doing this traveling, and I felt like I was stretched way too thin. So I went to Sir John and I said, if you were me, what would you do? Because I couldn't do it all, Hayden. And so he really simplified my life. He said, he was a very devout Christian, and he said, Chris, if all of us do the right thing, God will put plenty of bread on your table. So forget that part. So he posed the question, would you rather help, say, 250 people, the amount of customers I had in my practice, or would you potentially like to help thousands of people? And so I chose the latter, not about the money, but just to try to help people around the world. And I didn't know how, Tom Friedman wrote the book, Hayden, The World is Flat. And it was about, due to the advent of the internet, how ideas could just flow around the world so easily. I still find it hard to believe that this guy, I could get this thing, little research company that I've got going, and now people from 162 countries around the world are reading some of my ideas. I guess I punish people all over the world, Hayden.
And provide them with a good amount of success as well, I'd argue. Well, so that does a fantastic job of rounding up your background and kind of where your mind's at now. So I wanted to move on to the current market environment. I've heard you reference the terms dumb and smart money in previous interviews, both with Opto and other publishers as well. So could you firstly just tell us what you mean by this and how you distinguish between the two?
You bet. I want to give credit to the company, and I would encourage anyone that really wants to dig into sentiment analysis, Hayden, to look up the company sentimenttrader.com. They are, I've been a member of, I purchased their research for at least a decade now. They're a fabulous company that Jason runs. And so I've got to give all the credit to the smart money, dumb money calculations to Sentiment Trader. And what they've essentially done is they've found a couple of groups of people, Hayden, that for those that tend to buy at the highs and sell at the lows, in other words, about the polar opposite of what you should do, they characterize those as the dumb money. And then on the flip side, the group of money that seems to have success at buying in the face of pessimism and buying low and selling at higher prices, they tend to call that group the smart money. And so they chart these groups of the smart and dumb money every day, and they spit out percentages of how cocky or fearful is smart money, and how cocky or fearful is dumb money.
Yeah, interesting. So I guess we can tell things about the way the market will trend. For example, if there is overconfidence in dumb money, was it identifiable prior to the collapse earlier this year that there was a significant level of overconfidence in dumb money?
There was, Hayden. If we could turn back the clock, like the movie Back to the Future, if we could go back to, just call it January 1st, dumb money was extremely confident. It was either at the highest level of the past 2 years, or I actually believe it was the highest in a decade. In other words, they were feeling that 60 to 90 days out, stocks would be higher. And then at the same time, the polar opposite was taking place in the smart money. They were running for the hills. Smart money, I think only like 5% of smart money was bullish on the market. And on the flip side, I believe it was like 90 to 92% of dumb money was feeling like stocks would head higher. And so the stage was set. That's what I love about technical analysis. The stage will be set, and then it seems the market seemed to look for an excuse. And so later on in the interview, there was multiple divergences taking place for a period of time prior to the sentiment reaching that. But what took place did not surprise me. To the size and the speed, I humbly have to say that did surprise me, because it was obviously a really big move. I think it was the largest or the quickest 10% decline in 100 years. So I think that surprised most of us.
Yeah, I mean, that's definitely true. So then on the flip side of that, what does smart money confidence mean for equity markets? And are we starting to see that return now, or are we some way off that?
Well, smart money, on the first day of spring, which was March the 21st, smart money, as the market was declining, started getting very, very confident about that stocks were undervalued and should rally. And then on the flip side, Hayden, I think there was the fewest number of dumb money people bullish in a decade, at that same week in the third week of March, which was essentially the first day of spring. We'll talk about that later on. But anyway, at the market lows, dumb money was really confident. Excuse me, smart money was really confident, and dumb money was heading to the hills. And that was the complete opposite of the beginning of the year.
Yeah, that's interesting, and certainly an insight into some sentiment analysis that I wasn't particularly familiar with. So I'm sure our listeners will be really interested in that too. I want to move on to a book by Charles Mackay, The Extraordinary Popular Delusions of the Madness of Crowds. It's a pretty famous book, and I believe it was an inspiration of yours. It's a piece of writing about crowd theory, among other things. So firstly, why has that book proved such an influence on you specifically?
Well, it all started humbly with Sir John, Hayden. In 1995, Sir John said, Sir John had and still does, even though he's passed away, he would give away more money every year than the Nobel Peace Prize for the greatest progress of religious education. And so it really caught my attention when he said, outside of the Bible, and I'm going to stop for a second. He was known, Hayden, for being a great value investor, but this is what got my attention when he said, outside of the Bible, this book I've learned and has been the most valuable to me in my multi-decades of money management, which happened to be the Extraordinary Popular Delusions book. And the thing I found, and I still to this day find fascinating about it, is this book has nothing to do with valuations. It's just a book on sentiment. And as you said, Hayden, it's about crowd behavior. And so I made a promise to Sir John that I would continue for as long as I was in this business to share that message to other people, the same message that it changed my life, because I assure you it's not an easy read, but it's very much worthwhile. And as a friend of mine says, you can't unlearn something. Once you get the theory behind crowd behavior from this book in you, it just helps you so much at extremes. And that's why I think it's just so important at these inflection points that you can see the crowd getting really carried away one way or another. It just helps you so much, whether it's talking to somebody around the water cooler, your neighbor, a family member, or whatever. You will always influence you to kind of hear things differently.
Yeah, that's interesting. And then just building on your point about being able to read market sentiment at inflection points, we're seeing a lot of different inflection points at the moment with the historic levels of volatility in the market. So is this ability to evaluate mass market sentiment particularly valuable at the moment?
Yes, and really, it's a great question, and so valuable so far this year, Hayden, as far as when everybody was at one extreme earlier in the year. It's hard to do, but it was just a time that we walked away from the market. And one of the things that I found really difficult going back to 2000, Hayden, the 1990s in America was I believe the S&P averaged like 20% a year for a decade, and it had never done that in American history. So if you can imagine, after Sir John said, hey, you ought to be kind of giving up on buy and hold, that was a hard sell to tell people to do after this great decade. And so I came up with the idea that if you were a simple gardener and you had a crop of tomatoes in your backyard and that tomato became ripe and juicy and plump and it was heavy on the vine, what would most people tend to do? Well, they'd probably tend to harvest that tomato and pick it while it was ripe and juicy. But when it comes to investing, Hayden, people have a hard time picking that tomato. And so that so much reminded me of early this year, when the markets were doing well, dumb money was really cocky, valuations were incredibly high, resistance levels were in play, relative momentum was overvalued. That's a hard time to go pick that tomato. But I found in my 40 years, it's when it's that hard time, it's probably you're very close to the right time to do. And then turn the table to the first week of spring. We had this dramatic decline. VIX index is hitting one of the highest levels in history. If you do a Google Trends search report, everybody's, we're into a depression already, or we're heading that way. Fear was through the roof. People are just selling stuff left and right. That was another extreme, but rarely do we see both of those polar opposites, in less than 90 days, but we have this year.
Yeah. So then turning to how you're investing in the current market, have you been able to take advantage of this mass panic, I suppose, and of the recent stock market volatility?
We have, maybe on a different call, but one of the things that we found in looking back, we call it the 450s, that there was 50% declines or greater in the stock market in America over the last 100 years. And the one thing that we found is in the last three, which was 73, 74, 2000 to 03, and 07 to 09, Hayden, counter trend rallies, if you can believe this, they started the first week of spring. And then these counter trend rallies lasted over the last three times 8 weeks from the low. So we went to our customers on March, the first week of spring, and said, we believe that if history is to repeat, that we should see a strong rally going forward. If history is to repeat itself, it ought to last essentially 8 weeks. And the thing I find fascinating is you were innocent to this, that the rally essentially started on March the 21st. Excuse me, it was March 23rd. I apologize. 8 weeks later is this week. So we're finding it very fascinating that the rally that's taken place from a historical repeating pattern perspective was very much expected. It's been dramatic, but it's just right on schedule.
Yeah, interesting. Where do you expect major stock market or equity indexes to move next? Are we still in an uptrend, or are we headed downwards for the foreseeable future?
The market that's the strongest, that's really impressive, is the NASDAQ in the States. It's at highs for the year. It isn't quite as high as it was in February, but year-to-date numbers, it's in a positive. So the decline that it had during the big debacle, Hayden, did not break. If you take the lows of 2010 and you just would draw a rising support line for that entire 10-year period, what was beautiful about the decline in the tech sector, it came down and touched that 10-year support line in the third week of March and did not break it. So when you think of, I like the idea of getting in an airplane in a 30,000-foot view and looking at long-term, from 10-year trends to 100-year trends, in support lines. The most impressive thing to me is that tech did not break support. But when you start looking back, and like one of the charts that I shared with you, is what's interesting is banks started sending a bearish divergence message in January of 2018. Now that's 24 months ago. And as we all get caught up in this back and forth we've seen this year, I think one thing that I want to remind people of is ever since the day that banks started reflecting relative weakness, Hayden, the S&P has made a whopping 3% in 28 months. But then when you start looking at broader indices, as I shared with you, and you'll probably post that after the interview, when you start looking at the New York Stock Exchange, it's down 10%. When you look at small caps and mid caps, they're down like 15. Emerging markets, EFA is down 15 plus, almost over 20. Banks are down 40 over that time. So it's been really almost a bipolar market. There's no doubt tech is leading things, but the more issues or the more holdings you start looking at, the less participative to the upside that we are. Does that make sense?
Yeah, that makes complete sense. And just on your point that we'll be sharing those charts, we'll put them up on the Opto website for anyone that wants to take a closer look at those. So, I mean, we've touched on it a couple of times, but I wanted to dig into the specifics of your trading technique and any key charting indicators that you might use. But before we tackle the more granular techniques, it's certainly come across in this interview already that an overarching philosophy that you hold is this idea that chart patterns have a habit of repeating themselves. And having just covered your thoughts on the current crisis, I know that you have a lot of noteworthy charts from throughout history committed to memory. So I just wondered whether there was any that could help us see the way forward now, or even just perhaps mirror the prevailing trends in equity markets we're seeing at the moment.
Well, it's totally unproven, but like I shared, I find it fascinating that when that decline was so sharp, Hayden, and valuations are still lofty, I wanted to see, could we be repeating the past? Because I find that fascinating, and that's where I referenced earlier the 450s, the 450% declines, and so that's something that has me really fascinated right now. Is it's totally unproven at this time, but if history is to repeat one of these major bear markets, and the key word is if history repeats, I find it fascinating that the last three times, the first major counter trend rallies was 8 weeks in length, and then that's where things really rolled over, and that's when the largest portions of the bear markets followed over the next couple of years. So we're essentially right there right now. And so the thing that I'm finding fascinating is when you look at the chart of the NASDAQ 100, which is 100 tech stocks, and you divide that, Hayden, by the NASDAQ Composite Index, which is 3,300 stocks. So this ratio has been heading higher, Hayden, for 18 years. It's moved up since the 2002 low, which essentially reflects that a few stocks are powering the tech rally. In other words, the generals are moving forward, but the troops aren't participating to the same degree. And historically, when that happens in any market, when fewer and fewer issues are propping up the market, when the market finally does roll over, it sends a really important message. So what's the odds right now, Hayden, that ratio is at the exact same level as it was in the 2000 highs? So when I think of history repeating itself, I find it fascinating from a technical analysis that we could have a double top. I mean, tech's still leading. The tech has not acted weak, and so the odds are it breaks out. But we have to sit back and remain open-minded. That is there a possibility that NASDAQ could be double topping 20 years later? And that's when you talk about repeating patterns. That's one I really find fascinating right now, because when you look at monthly chart patterns, I'm a fan of weekly charts over daily and monthly charts over weekly, and that in March and April both, that ratio of NDX divided by the NASDAQ Composite Index created back-to-back large bearish reversal patterns exactly at the 2000 highs.
Yeah, interesting. I wonder whether that has something to do with liquidity as well. Sort of everyone piling into the top names in those indices that you mentioned, like the Nasdaq. Would that be fair?
It sure could. There's no doubt that the so-called FANG stocks in the States, with Facebook, Amazon, Apple, Netflix, and Google, they've had a huge influence, on this. And so one of the things I want to be really watchful of here is dividing the index by the S&P, because tech has just beaten the heck out of the S&P over the last 10 years. If tech would start reflecting relative weakness to the large caps in the S&P, that would be a concerning message. That has not happened, but that would be something that we'd want to watch for a signal that if that happens, Hayden, that would suggest that we're in a counter trend rally in a new downtrend.
Yeah, interesting. Certainly one for our listeners to watch out for then. I would strategy then, like I mentioned a moment ago, and just kind of from the beginning of your process, do you consider a specific risk reward ratio before entering a trade?
My ideal setup is a situation where a market, Hayden, is on support, the longer term support better. I love if we can add to it that it's oversold, that relative momentum is at one of the lower levels in years. Then when you combine, say, a sentiment trader, if you can get smart money to be feeling confident about the market and dumb money being concerned, these are all setups that are ideal. And that's when we want to be more likely to take an aggressive long position when these kind of pieces fall into play.
Yeah, so in terms of idea generation, then how do you come up with an idea like that? Are you using sort of a specific piece of software to help you screen for emerging chart patterns?
I do. I first have software look for certain types of patterns, and that's the initial screen. I have it do the search on indices, Hayden, and individual stocks as well. And it's not perfect, but at least it gives me an initial, like the other day, I was looking, my favorite pattern is what's called the ascending triangle. And whether it's a stock or an index, let's say the stock had been hitting the $100 level several times. So you would have a horizontal resistance line, but over many months, it continued to make a series of higher lows. And so that's the ascending triangle pattern that 2/3 of the time assets break to the upside. And then if you take the distance of that flat top to the rising bottom, and then that's called a measured move, that will give you an idea of how much that asset could gain. So as an example, I have then my software go and search of all the S&P 500 stocks and indices. Does it find those patterns out there? And so that's how I do an initial search for certain types of setups.
Yeah, interesting. I was going to ask you a favorite pattern or one that you'd had particular success with. So would you stick with that ascending triangle in answer to that question?
I would, Hayden, because the neat thing about an ascending triangle pattern, and I had nothing to do, with creating these chart patterns or the history behind them. I'm just a follower of great people long before myself. But these take place in an upward trend. So in other words, there's many times I like to try to bottom fish, but the reason I like the ascending triangle is it is taking place in a bullish trend. So you're not trying to bet that something's going to reverse. You're not trying to catch a falling knife. What you're trying to do is find a breakout level. And, we live in a world that I believe information is easy to access. And so if simple me can find this breakout of this $100 level, I suspect there's other people around the world, great people like yourself, that can also spot the same thing. And if there's enough people that do spot this breakout and enough people pile on board, there's a chance that that buying pressure can help it succeed in a move to the upside.
Yeah, interesting. Sort of reinforcing a pattern that already exists.
Yes.
So once you've identified that chart pattern, then you know it's kind of worthy of further investigation. What's the next step? Are you kind of overlaying any additional indicators like moving averages and things like that? Can you talk us through that process?
Yeah, typically, if the ascending triangle has lasted a while, great question, Hayden, a lot of longer term moving averages almost flatten out, because, you know, if you think about it, it's been choppy for a while, even though the longer trend is up. And so then if it breaks out, you'll start seeing those moving averages tend to curl up. And we all know there's a moving average community that if certain assets break above those, they'll also pile into the market. One of the things, while we're kind of on the moving average idea, Hayden, is that was the main tool that I used from 2000 to 2003. But one thing I learned a lot is, as we all know, moving averages, every strategy, I love this theme, is every strategy has its weak points. And so the strength of a moving average is if an asset is moving up, so's the moving average, it keeps you long. And so you ride that trend. And the same thing on the downside. If it's down, you continue to either remain outside of that asset or you short it. But the one thing that I really found fascinating is for a trend to change. In other words, if a top takes place, the moving average is not going to roll over for a while, as you and your listeners know. And the same thing with the bottom. The moving average is going to bottom later than the market itself. And so the one thing that I found is that in these major turns, I actually, the weakness is you leave a lot of money on the table. You know, you don't get in as quick as you possibly could, and you don't sell at the high. You know, you need to let the high go by. And it's not that is bad, but that's where I really started getting into, I call a strategy of mine, tops, bottoms, and no middles, trying to really find those inflection points. And so that's one of the things that we try to specialize in, is finding these inflection points where key reversals can take place. And if you can spot those, as great as the moving averages are, you're going to be a little bit ahead of them. And so I've really worked hard to try to tie, when you think about, you look at a high on a chart, Hayden, the smiley face, a high on a chart is just nothing more than a whole bunch of people being happy. And a bottom on a chart is a sad face. And so I just call these emotive points. And so a high is obviously an emotive point of euphoria. And on the flip side, a low is an emotive point of pessimism. And I find it fascinating. And I don't think if I ever lived 200 more years, I'd ever know why. But it's amazing when you start tying these emotive points together, how oftentimes you can really find key inflection and reversal points. I've given up, Hayden, on trying to find out why this happens. I just have done it 2 or 3 times. My wife laughs at that and goes, 2 or 3,000 times in 40 years. And it's just amazing how the technical analysis can work. When you think about that, these price points all come together by billions of free thinking people all over the world.
I mean, to do that then, and just to take you back to an earlier point, you mentioned sort of your preference would be at least a weekly chart, and you might have even mentioned monthly as well. Is that the time horizon you're kind of operating on to capture these moves?
Yeah, and I love, like, one of the charts that I sent you that the viewers can view is the Thomson Reuters Equal Weighted Commodity Index. And so I find it fascinating right now that the index on a monthly chart created a high in 1980, and then commodities lagged for just short of 20 years, and then finally they started turning up, and so they went well above the 1980 high. People will see, but then we had the financial crisis, as we all know, in 2007 to 2009, and commodities did not escape the quote unquote financial crisis. They got sucked into the action. But when you ask Hayden about monthly charts, the thing I find fascinating is, when you see a monthly on a candlestick, a bullish reversal or a bearish reversal, historically that often means either a buying or a selling exhaustion point. And so I find it fascinating that the commodity index created a bullish reversal pattern at the 2009 lows, which was the exact same price as the 1980 high. That's almost 30 years later. But it ended up sending a message that, I recently watched the movie of Churchill called The Darkest Hour. And I think of that movie when I look at that chart pattern, that bullish reversal reflected that the darkest hour was there. And then some better times took place. And so then now you turn the page forward. In March and April, the Thomson Reuters Commodity Index is at the exact same level as the 2009 low. And both of those months created bullish reversal patterns at this 40-year support level. So I humbly don't know how this stuff happens, Hayden, but being an optimist, I hope that this pattern is suggesting that the darkest of times through this, the commodities have been something to avoid now for over a decade. I don't have a bias hat, but I would love for the world to start witnessing some higher commodity prices at this 40-year support line, because maybe it means for the most of us around the world that maybe the worst is behind us.
Yeah.
We can make money, and no matter how the markets go, I'll stop on this. No matter how the markets go, we can make money. But I do have to say, I'd like for the commodities not to continue to collapse, because if they do, I think we're all in for some struggling times. Not that we can't trade our way out of it, but I think the world would continue to deflate if that commodities index succeeds in taking out the 09 lows.
Yeah, that's really interesting. And actually, that commodities chart that you're referencing there does make a particularly compelling case for the end to the downside on the commodity side of things. So we'll certainly share that on the Opto website straight after the interview. So to move on to equities, obviously we focus on stock markets here at Opto, so I'm sure our listeners will be particularly interested to hear, just from a personal perspective, how much of your portfolio is allocated to equities right now?
We're essentially just half exposured to the long side. Don't own any shorts of that half exposure. It's weighted towards tech. As I shared earlier, the S&P in 28 months has made a big 3%. One of the charts I also shared with you, Hayden, was a chart on what's called the Buffett indicator, which takes the value of the stock market and divides it by the overall economy. And this was one of the tools that Sir John highlighted in 1999, why he felt stocks would struggle to make a quality buy and hold performance for the next 15 years. And so I'm kind of reminded, Hayden, of Sir John's talk with me, because when we look at the Buffett indicator today, it's essentially at the same level as 2000. So, this would suggest that it doesn't mean a major bull market is coming, but I think I would try to mentally be prepared for long-term below average returns based upon where valuations are.
Yeah, that certainly makes sense. And before I move us on to kind of some more upcoming trends to watch out for, I suppose. I'll just point our listeners in the direction of some further detail on your trading process. We actually interviewed Chris about a year ago now for a free ebook, and you can find that by typing Opto Tricks of the Trade into any search engine, and we'll also include the URL to that free ebook in the episode description as well. So just for some further detail on the points that we've discussed just now. So on to the upcoming opportunities then. I wanted to dig into any upcoming trends that you see in global equity markets, any particular patterns our listeners should look out for. I did read a recent post of yours about banking performance on Kimble Charting Solutions.com, and how it can often indicate broader market weakness. Banking stocks don't look particularly appealing right now. So is there any more disappointment to come? What's your take on that?
Well, they started, as we shared earlier, Hayden, they started suggesting a cautionary message in January of 2018. And when you divide the banking index in the States, which is BKX divided by SPX, it's hard to believe that ratio is now below the financial crisis 2009 lows. So I suspect it has something to do with low interest rates, Hayden, that banks aren't real appealing to a lot of investors. But I love the adage that I heard years ago that says, so goes banks, so goes the broad markets. And so that's why I like to focus. We started sharing this negative divergence with our customers well over 2 years ago. A lot of people talked about the decline of this year, quote unquote, Hayden, was a black swan. And I'd beg to differ with that, because the idea of a black swan is the unexpected. Well, Hollywood had made 3 large budget movies about a virus or a pandemic. So we don't know when, but that part shouldn't have been a surprise. And then there's been bearish divergences taking place for quite a while. And one of my favorite indicators for bearish divergences is junk bonds. Junk bonds in 1998, I like to call junk bonds, Hayden, stocks and drag. They're imitators. And in 1998, junk bonds started creating lower highs for 2 years. And then stocks peaked in 2000, and we know later they fell 50%. So junk bonds send a quality message to people well ahead of time. Hey, something doesn't look good underneath. The foundation is showing some cracks. Now, at the 2007 high, junk bonds gave a bearish divergence message that lasted about 8 months. And I've humbly felt like I don't think I would ever see again junk bonds send a bearish divergence message to stocks for 2 years or more, similar to 1998 to 2000. But junk bonds have created a series of lower highs, Hayden, for the last 5 years. So, has stocks gone up for 5 years? Well, they have. But there's no doubt that junk bonds are continuing to send a suspect message about long-term stock market buy and hold performance still to this day.
Yeah, wow, that's really interesting. And I guess I want to turn our minds to the more positive side of things, I suppose, and whether you do see any opportunity in other sectors of the equity market. I wonder whether there's a specific sector or even an industry that jumps out to you.
Yeah, one of the things that when we go back to the favorite pattern of the bullish descending triangle that we talked earlier, Hayden, recently we just published the similar looking chart of this on the biotech industry. And there's 2 key biotech ETFs in the States, which is IBB and XBI. And they both, one's an equal weighted, one's a cap weighted in the same industry, but not a surprise. Both of them are creating this same pattern. They've created flat tops for the last couple of years and higher lows. And over the last couple of weeks, they're both making an attempt to break out to the upside. Similar pattern would be Netflix. Netflix has created a series of flat tops and higher lows. And earlier we talked about that a an ascending triangle gives you the aspect of a measured move. It's crazy that the measured move pattern on Netflix is calling for it to rally another on a breakout, that over a period of time it could rally another $200 per share. So those are some interesting, the bullish upside patterns that we're watching closely in that bullish ascending triangle pattern.
Yeah, interesting. On Netflix, then, I mean, is this a shorter term move, or I mean, I guess in part that Netflix trend is being fueled by this idea that obviously everyone's spending more time at home. Streamers in general have moved up quite nicely since the middle of March. I wonder whether we should expect a similar valuation in a few months' time, or whether this is actually a shorter term peak that will come down in a month or so.
That's a wonderful question. It hasn't proven that it's taken out the upside. What our game plan is let's just go back to the example. I know Netflix is not at $100 a share, but just say the top line of any asset was at $100. If it breaks out above that, we want to be long. But then the trading strategy, Hayden, would be then is to set a stop loss fairly tight below that 100 level in case that becomes a fake out move. But if it is a bullish breakout, we want to be long. And I know we're getting close, in time, but gold created one of these patterns a couple of years ago, to where it had a series of flat tops and rising bottoms. And to our members, we shared that the measured move on gold was suggesting that gold should run into resistance around the 1794 level. And so it's taken 2 full years after the breakout. Gold's rallied close to 30% out of that pattern. And now we've met the measured move targeted upside objective. So gold's been popular. I would suspect, if anything now, gold needs to catch its breath at these current levels and back off a little before heading to much higher levels.
Yeah, sure. And can I just pick you up on the biotech point that you mentioned a moment ago? Obviously, we're seeing a positive trend there, like you mentioned. But so I've read that short interest has been in the 49 billion range for most of the year. So huge short interest there. And actually, biotech short sellers are down about 2.8 billion for the year so far. So a similar question to my Netflix one, I suppose. What's your outlook for that sector in particular for the medium term, I suppose? So beyond this short term uptick.
Well, I think I don't tend to look for. We did a video to our customers how one of the most costly lessons that I've ever learned, or that I've noticed people has cost them a lot of money, is searching for the why, WHY, why things happen. Because as Benjamin Graham said, Hayden, Mr. Market's job is to fool the majority of the people the majority of the time. And so the why is fascinating. These things could work. Like if biotech breaks to the upside, if I was searching for a why, I would say, well, it's probably because of this virus that a lot of money is flowing into this sector in trying to solve the world's health situation, right? It's pretty popular. That's who's going to succeed in coming up, with a potential solution, antibodies or a vaccine. So I think that could be why some relative strength. But if I could encourage anybody to do this, I've got a way, because all of us, I think internally, we have our own biases. It just happens. We're human and we're normal and we have biases. And so one of the things that's been most productive for myself, Hayden, is in one of my pieces of software, I found a way to hide the name of what assets are. So I just look at chart patterns for what they are. And then what I do is I have about 140 different assets that I look at the chart patterns, And then I narrow them down to my favorite 10 or 15, say, I really like this, and here's why, and here would be my game plan. And then one of the last things I do, Hayden, is I find out what the asset is.
Yeah, sure.
That helps me tremendously to see the pattern for what it is and to try to reduce my own personal biases as much as possible. Because we all have them, and I don't care how long I've been around the block. We all have biases. We see things certain ways.
I don't know. I think you're completely right. Removing the name of the asset. I mean, I hear a lot of people talk about human biases and trying to get to the true value of price and sort of stripping out away any biases and sort of external fundamental factors. But to actually hide the name of the asset isn't something I've heard before. So that's really interesting. But I wanted to finish the episode with a quick fire question round. So there's just going to be 5 questions, all fairly simple, and you can answer in as little as 1 sentence or even 1 word, if you like.
Now, you didn't tell me you were going to put me under this kind of pressure, Hayden.
Yeah, exactly. Well, so the first one, hopefully, we'll start off easy. In your opinion, what's the top mistake investors make?
Getting caught up in headlines, thinking that you can use a bit of news. Because I'll say this, I used to express concerns to Sir John, I express my bias or whatever. And so Sir John would say, Chris, do you know a secret that the majority of the most powerful people in the world don't know? And every time, all I could ever say, Hayden, was, no, I don't. And he says, so if you don't know a secret, then the news that you're seeing is most likely already built into the price. And so that's a longer answer than you probably wanted, but that's why I think getting caught up in the news can be really costly to your bottom line.
Yeah, some great advice. The second question then, where do you go for your trading insights?
There's some really good trading books of a long time ago. Ralph Ackman-Pura is a pioneer in this business. But one of the things that I've learned so much from is a gentleman by the name of John Murphy, and he can be still found on stock charts frequently. John's got a lot of books. A very humble guy. Learned a lot from John Bollinger.
Yeah, that's interesting. That's actually a book that's been brought up by a previous guest, I believe, another technical analyst in the name of Trevor Neal. So that's really interesting. You picked that one out as well. My third question then would be, is there a most memorable moment from your career so far? Is there one that particularly sticks in the mind?
Oh, I guess Warren Buffett named his company Hayden after one of his biggest mistakes. And Berkshire Hathaway was something that he made a big investing mistake. And so part of the reason I said getting caught up in the news, in the early 1980s, I was getting married, wanting to go on a honeymoon. We're going to go to Disney World. And so I had some money set aside for the honeymoon, and I thought I had the world by the tail, and technology was doing well, and Fidelity had these new select funds, and one of them was Fidelity Select Technology, and that thing had done well. And so this is where I say, don't get caught up in the news. I made that mistake. I got caught up in the news. I put all of my honeymoon money in this Fidelity Select Technology Fund, and I'm going to make my honeymoon all the better. And next thing I knew, in probably 100 days, I was down 25%. So I was lucky that we made it to Motel 6, much less Disneyland, after that mistake.
Oh, yeah, that sounds like that one particularly stung. So just 2 more then. Firstly, the top tip for your younger self.
Great question. Top tip. Be patient. Don't force trades. Keep the long-term perspective in mind, and do as quality a job as you can of trading against the majority of emotional opinions.
Great. So final question then. I wonder what gets you mentally ready as part of your morning routine?
I'm usually up 4:35 in the morning. I'll be 63 this summer. This is my 40th year in the business, but I'm very passionate about it, Hayden. I love it. I don't have any problem getting out of bed. I look at this as a giant game of strategy, just trying to figure out the world and figure out emotions. And so I find it fascinating, but, like many of us potentially in the quarantine, a lot of people around the world have binged, movies, or they kept watching a series. I kind of look at the markets, Hayden, is just one giant binge movie that never ends, and so I'm always fascinated for the next chapter. It's just, I'm very passionate about this, trying to figure things out. It's a lot of fun.
Yeah, that's great. All right. Well, that brings us to the end of the episode. Thank you very much for joining us, Chris. It's been a real pleasure.
Thank you for the great job you do, Hayden. It's a real honor and pleasure to be here.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.